In this past week, the major data point that everybody paid attention to was the consumer price index and the rise. We had an 8.2% rise in inflation, which was unexpected by the market. Hey everyone, this is Rob Kientz from goldsilverpros.com here with your weekly market wrap for October 14th, 2022. This is going to be a review of the major economic data points of the past week, a review of gold, as well as a preview of what to expect in the coming week. And without further ado, we're going to jump right into it. We're looking at the economic calendar. In this past week, the major data point that everybody paid attention to was the consumer price index and the rise. We had an 8.2% rise in inflation, which was unexpected by the market because they were expecting with the Fed interest rate rises that inflation would start to come down. It wouldn't be quite as persistent, though it is persisting. And we had a crash on the markets about midway through after the data was announced on Thursday. It crashed. The markets opened down slightly less than their percentage. They were down in early morning trading, but recovered to go up about 2%. And on Thursday and Friday, as we're recording this, we're looking at it, and the markets are trending back up again. Now that's the stock markets. The bond markets are still experiencing some issues. As we look at the 2-year, we're sitting at 4.413%. The 10 years at 3.893. We still have that yield curve inversion, which is indicating a recession. But the more important point is that the 2-year continues to be persistently above 4%. Long term, this could have a negative effect on the market as money becomes more expensive, and as well on the ability of the government to pay down its debts, because it'll incur more interest expense. I don't expect at this particular bond rate right now that it will break the system. However, bond rates keep going up, it will put pressure on that system. We'll have to see what the Fed does with its interest rates and how the economy reacts. In other news, UK Finance Minister Kwasi Kwarteng was fired after market chaos and tax-cutting plans, is the headline from CNBC. He cut short a visit to Washington on Thursday to fly back to London as government ministers scrambled to address the market chaos. This included a sell-off in long-dated government bonds that led the Bank of England to intervene in order to save pension funds from collapse and a spike in mortgage rates for homeowners. The UK is experiencing some severe economic stress. Look for their central bank to come out with policies and their Congress to come out with policies to address the issue. We'll follow that and see what happens. Gold and silver are down for the week. Gold started the week a little bit above 1710. As of time of this recording, it's trading at 16.55 and 78 cents. Silver started the week above 20.5. At the time of this recording, it's trading at $18.68. So both are down. Gold down about 0.5% on the week. Silver down about 1%. Again, that's just the futures trading. All reports are that the physical market is strong, and we continue to have near-term supply shortages in silver, rising premiums, and enhanced deliveries and purchases of gold. I'm going to start the share screen, and we're going to show you the gold and silver markets. We'll start with gold. Overall, we saw fairly even market until yesterday, when there was a spike up in the overall volume and open interest of trades. As we look down here to the dominant contract in December of 2022, as I've highlighted, we see that so far there were 2,113 contracts in exchange for physical, and that is an exchange for physical between the COMEX and the London markets, meaning people are exchanging their futures contract for the ability to get real metal in London, or to cash settle, or to take a position in London. A little bit of repositioning there as well. Total volume for yesterday was 237,007 for gold, and we'll see what happened with the prices as we look at the settlements According to the CME Group, the dominant month for trading gold and silver right now is December on the futures contract. It is a future, so the dominant month will be in the future. December is always a big month for both gold and silver to end the year. And you can see right now that traders are positioning down. Gold was down, traded down half a buck yesterday on volume of 237,000 to settle at 1672. As we look at the week, we go back to Wednesday. As you see here in December on this line, we were down $8.50 on contract volume 132,761, and that continued throughout the week. And that's why the spot price of gold is falling, because it's determined right here. You can see the prices right here from the CME Group on what's trading on the COMEX. Moving over to silver, similar situation in silver, a little bit of spike up on the 13th. That was mostly shorted volume, as we can see. Exchange for physical had 1,155 contracts of 5,000 ounce silver, meaning people were arbitraging between the United States and UK markets, perhaps to take delivery of physical off of the UK markets, or just to do a paper for paper arbitrage play, which is possible with the EFPs. Moving over to settlements, we can see yesterday on the December contract that silver settled down 20 cents to close at 18,918 on the strength of 74,151 contracts. Moving over back to Wednesday's data, you can see that silver traded down about 55 cents on the strength of 58,640 contracts. Again, you can see why the prices are coming down, because they're determined by the derivative trade, not necessarily the physical trade. Let's take a look at the commitment of traders report. This is the positions that the traders take that we see in the charts over here. So all of the settlements that are occurring, all this movement in the trade is reflecting commitment traders. This is as of October 4th, 2022. The data is behind, as I've mentioned. It's usually a week to 10 days behind from the CFTC as they gather and publish the data. So we're taking a look back, but it explains what happened a week ago. And we look at silver and gold, and the first thing we look at are the positions, and we start with the swap dealers. The swap dealers added 5,602 contracts short, so they moved a little bit more short for the week prior, having them close at a net long position of about 11,200 contracts. So they're still net long. The bullion banks are, I consider them to be the smart money most of the time. And so what that means is we expect the silver price to rise because they're net long. Of course, the producer merchants are short because they're hedging their downside price risk, especially the producers as they sell the metal. Merchants probably have most of the net long positions, not much to report there. The managed money did something astounding. I think the managed money may be watching these reports every week, because what happened is the managed money usually takes the opposite side of the bullion banks, and the bullion banks are being experienced in this market more than the managed money usually win that trade. That's why I call it the swap dealers or the bullion banks the smart money or the sharps. Well, managed money must have picked up on what I was reporting or what they're seeing in the market. And so they dropped 10,000 contracts short and added 3,456 long contracts for a net change of about 13,500, almost 600 contracts to the long side. So they're moving more long. They're still, they're now net long in silver, 37,885 to 32,000 short. So they're now net long 5,000 contracts. They're emulating the swap dealers. Again, I think they're watching the report. They're getting smart. So who took the shorts? Well, the other reportables are still net long about 4,000 contracts, but they did drop 1,500 from the long side and add 4,200 from the short side. So I think the family offices and wealthy individuals, which fit under this other reportable category on the chart COT report from CFTC, are essentially going more short. So some of the smart individual and family office money believes that silver will continue to move down. That's probably because of recent price action. We'll have to see what will continue to occur. As we look at gold here, also for Friday, October 4th, looking back at the previous week's data, we see a change here in gold as well. We see that the swap dealers actually reduced their net long position by 2,800 contracts and added net short position 25,000 contracts. So I'm expecting the gold price to continue to fall a bit. Of course, this is backward data, so this is actually data that I just explained to you happened the past week. But if this trend continues and they continue to add more shorts, I would continue to expect downward price pressure in gold, because this is actually how price is determined, or the positions on the COMEX, which is reflected in the COT report. We're actually seeing who caused the price to fall in the data I just showed you, because that's how the spot price is determined. It's not determined by the physical trade. It's determined by the derivative markets here in the U.S. And of course, in gold, we continue to have more shorts than longs because the producers are hedging their downside price risk. And the managed money, they reduced their short position in gold 27,584 contracts and went net long 8,635 for a net change of about 36,000 contracts to the upside. That's an astounding move. If you look at what's happening, the managed money, if they did it one more week, would be net long on gold while the swap dealers are going short. So I expect the gold price to continue to fall if that trend follows. The other reportables didn't have much movement. 175 additional long contracts, 90 additional short. Net went additional net long just a little bit. If we look at the ETF scene, specifically SPDR in gold and SLV in silver, which I'll get to in a minute, as well as some of the others, you can see that there was a sell-off in the actual physical inventories. Here are the COMEX numbers up here. They were all down registered, eligible, and total inventories. We saw the ETFs sell off for a net change over the last month of negative 3,700 ounces of gold. And you can see gold ounces held are falling here on the chart as well. Let's take a look at the silver ETFs. They have dropped over the last 4 weeks, and COMEX and the ETFs have dropped 24 million ounces of physical silver, although the SLV has added 7,181. That, however, is a drop from last week's 4-week data, which means they lost 5 million ounces in the last week. COMEX, you can see, is bleeding with all the red. Net silver is falling. Overall, net silver total ounces held have fallen. Now, we still have lots of ounces available, 1.4 billion ounces across the ETFs and COMEX. The question is, how much of those are actually in registered or in liquid categories that aren't already owned? You have to subtract out this eligible category for COMEX, at least 5 million ounces of silver, because that's private storage. The CME Group has actually come out and said that. And so we still see the inventories draining in both gold and silver, meaning the physical trade is still very strong. So while we see weakness in the derivative markets because they're trading what they think the metals will be in the future, and I can see their opinion being that the metals would be going down because the markets have rebounded even on negative news in the economy, I expect there to be some downward price pressure in silver and gold going forward. But again, I'm still counting on the weakening economic data to boost gold and silver over the medium to long term. And I expect the love trade in the physical side of the gold and silver markets as people buy physical overseas for the various ceremonies and dowries will continue to put additional pressure on physical, but we won't see a big upside move in gold and silver until one of two things happen or both happen at the same time. We have a shortage condition, the physical metal, that would be more rapidly approaching for silver than gold. There's still a lot of above ground gold available because it doesn't get as used much industrially until somebody big comes in and starts buying up big amounts of gold, like the central banks or sovereigns or very wealthy individuals. I do not believe that we're going to have a shortage condition in gold. So what else could cause them to move up? Well, additional geopolitical concerns, additional pressure on world economies. We talked about the UK economy and the US economy. Even though the US markets moved up, it was on negative economic data. I think that's a euphoric bump that's not supported by the data and probably will come back down. But we'll track that as the weeks go on, as the year progresses, to see what happens there. I'm still bullish on gold and silver. And as we look next week, we want to take a look at the economic data that's coming out. Going back to the economic calendar next week, we have a lot of what I call boots on the ground or close to the surface type of statistics. We have the New York Manufacturing Index. It's called the Empire State Manufacturing Index, Industrial Production Index, Capacity Utilization Index, NAHB Home Builders Index, building permits, housing starts, Beige Book, and then we have jobs data, initial jobless claims, continuing jobless claims, Philadelphia Fed Manufacturing Index, existing home sales, so on and so forth. A lot of economic data coming out next week, and it's in real stuff, real fiscal stuff, real things that are going on, manufacturing and things like that. This will be a big week to tell us how the economy is actually doing. If a lot of those numbers miss, we could expect to see the broad market sell off and gold and silver to rise. We'll see what happens. It is quite possible that we have a little bit of reversal in gold and silver as that news comes out in the economy. We will track it right here for you. That's going to do it for this week's weekly market wrap up. Thank you so much for paying attention. We will see you guys next week.